for every dollar you spent, you can deduct 20 cents off of it.
Okay.
Okay, so you're not saving money. You're not getting money back. It's just you get a little bit back of what you spent.
Hey, Mike, people always talk about deducting their expenses. Is it really worth it, and what counts for a deduction?
Yeah, so let's talk about a dear friend of mine, a CPA. He calls it the 4 flavors of tax.
Oh,
This is important.
okay. Flavor 1, what is it?
Yeah, flavor 1 are tax credits.
Mm.
So not a deduction, a credit. A credit is a dollar for dollar off your tax bill.
Yeah, so this is like just like you're getting like money back, or like if you owed a certain amount of money, this credit reduces what you owe by like a
Yeah, so
full
let's say
dollar,
your
right?
taxes, easy math, $10,000, and you have a $5,000 tax credit. You just take $5,000 off the tax bill.
Nice.
That's the simple explanation.
So
Okay,
credits are what you want.
we like credits
If you can get them.
It's hard to get them. Okay, and usually tax credits come at a high price. There's a reason why they're credits. So,
Like you have to have many children.
no, those are deductions.
Oh, really? I thought what about the child tax credit?
Yeah, I guess the credit there.
Yeah.
Yeah, I stand corrected on that one.
Yes, thank you.
But
anyway,
but
credits.
that one's changing because of the one big beautiful bill. So that's
Al-
why I say
always changing.
there were some deductions based on if dependents, and there were some on if they're your children. So things have shifted in that department. So look into that a little bit more.
Yes.
But I digress.
Yes.
But tax credits, dollar for dollar.
Okay.
Okay, great. Off your tax bill. The next one is the deductions. Okay. So if you deduct something, it means, let's say your tax rate's 20%, your effective tax rate. Okay. So, or whatever the deduction rate is. So you basically it's if you spent $10, for every dollar you spent, you can deduct 20 cents off of it.
Okay.
Okay. So you're not saving money. You're not getting money back. It's just you get a little bit back of what you spent.
Is it reducing your taxable income just fractionally, or?
Yeah.
Okay.
You're not like when people say, "Oh, I'll just deduct this and it's fine."
Yeah.
Okay, you're spending 80 cents on the dollar. You're still spending money. So don't think that you can deduct your way out of losses or out of spending. That's just why I think it's kind of a funny situation.
Right.
Now, back in 2016, the standard deduction was low. And so a lot more people would itemize their deduction. When you itemize your deduction, that's when you're saying, okay, well, hey, I did a lot of charitable contributions. I did a lot of these other things, a lot of business expenses. I can itemize the deduction. And so if I get 20 cents back on every dollar I spent, that's a greater benefit to me than just taking the standard deduction. But with the standard deduction today being so high, most people, I think it's like 90+% of people just take the standard deduction. So in that situation, it's like, yeah, you could deduct the expense, but you'll have less tax benefits when you file than you would if you just take the standard deduction.
Yeah. So you might want to look at when it's time to do taxes, total up all of your itemized and see if it's greater than the standard. And now maybe it's not as much.
Yeah, many times it's not. It's like people say, well, hey, don't you want to get all these bills? I'll say, well, are your bills or the things you can deduct greater than this amount? They'll say, no, not even close. Here, you're taking the standard deduction.
Yeah.
So for those that are charitable or could be kind of near the threshold, typically what I like to see is that they'll do all of their itemizations, the itemized deduction kind of transactions in 1 year. So maybe in January and December is when you do your charitable contributions, you're doing your donations, you're taking it to the thrift store, whatever it is, but you do that all in the same tax year. So in 1 year you do the itemized deduction, and then the other year you do the standard deduction. You can kind of go back and forth.
I see. Interesting. Okay. So that's flavor 2?
That's flavor 2.
Okay.
Flavor 3, this one is the deferral, tax deferral.
Oh.
So your 401k, when you defer taxes, you defer income tax.
Oh, right.
What you're doing is you're just saying you're going to pay it later. So your IRA, you've deferred taxes to be paid at a later date. That is a benefit, but it's also a detriment because if tax rates go up in the future, if your account gets very, very large, RMDs, there's a lot of things that could blow up in your face. But overall, it's a pretty good benefit if used appropriately and is in balance with your other tax accounts. So you've got IRA or pre-tax, that's qualified. So it's a retirement account. It's not subject to capital gains. It just grows tax-free, but you're going to pay taxes in the end. Then you've got your tax-free account, which that's the fourth flavor of the tax.
Oh,
It grows tax-free and it pays out tax-free. So that's just
okay.
tax-free. Okay.
Yes.
Grows tax-free, pays out tax-free. Your Roth IRA is an example of that. Okay. And then you've got your brokerage account. So it's subject to capital gains. If you trade it, you're going to pay some sort of tax, whether it's short-term or long-term capital gains. But yeah, those are kind of the four flavors of taxes people need to be aware of. You've got, again, tax credits, dollar for dollar. It's great benefit.
Get those if you can.
Tax deductions, you're getting a percentage back on what you spent, but you're not going to deduct yourself into profits. Then you've got your tax deferral, you're kicking the can down the road. And then you've got your tax-free, which is Roth, IRAs. Life insurance, if you borrow against the policy, will also qualify for that as well.
And then there are some like municipal bonds or something that are
The interest on the municipal bonds, it's tax-free.
okay.
Yeah. But not all tax-free, like municipal bonds, qualify for certain benefits. So your municipal bonds could disrupt your Social Security taxes. Your municipal bonds could disrupt your modified adjusted gross income, which could affect your new senior deduction. That's through the One Big Beautiful Bill. So it's a very complicated situation, but the moral of the story is don't spend money thinking you're going to get it back through deductions. That's not a real situation. And expect that most people are going to take the standard deduction. So don't be like, well, I can deduct this. You're probably not going to deduct it. Most people in retirement don't really do many actual itemized deductions. It just doesn't make sense for them.
Okay, so the answer to this question then is it really worth it? Probably most of the time not.
Probably not. If you've got a business or a special situation, seek a tax professional that can break it down. We're happy to break it down for you as well. But all in all, it's just assume that you're going to take the standard deduction unless proven otherwise. Still look into it. There's always an exception to the rule. Maybe you're the exception to the rule, but don't just assume that you are. Trust but verify. Assume but verify. You're listening to How to Retire on Time. Hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth, who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.